Hey everyone, Matt from Stock Trades here. Today, we're going to take a look at dividend growth stocks. In particular, we're going to check out those who are scheduled to raise dividends between mid and end of October. And we'll get to that right after this. Before we jump into what companies are on tap to raise dividends, I just want to bring investors' attention to the different methods by which we can track dividend growth. There are two main lists in Canada. One, the Canadian Dividend Aristocrat list, which is an index and put on by S&P Global. The second is the Canadian Dividend All-Star list, which is maintained and held by a prominent Canadian blogger. It's very important to understand the difference between the two because there are differences. First, let's start with the All-Star list. It's important to note that the Canadian Dividend All-Star list uses the record date in order to calculate its dividend growth streak. This is an important distinction to make because the Canadian Dividend Aristocrat list does it differently. The Canadian Dividend Aristocrat list can be a little bit deceiving. If you check out its website, it'll say that it tracks companies that have a policy of consistently increasing dividends every year for at least 5 years. Now that seems pretty straightforward. However, you'll notice I've highlighted this particular sentence. The security has increased ordinary cash dividends every year for 5 years. Straightforward, yes. However, it goes on to say, but can maintain the same dividend for a maximum of 2 consecutive years within that 5-year period. That is a very big difference than the All-Star list. The All-Star list will drop the company if they don't raise dividends in one calendar year. The Aristocrat list will actually keep them on the list if they maintain their dividend and don't cut. And the second difference is that they are based on EX dividend dates. So you have two lists that track dividend growth companies. I actually see flaws with both of these methodologies. Personally, I'm a fan of David Fish's CCC list south of the border. Why? Because they track the dividend streak based on payable date. I like this because this means that the company has paid out a higher dividend year over year. If you play around with declaration, EX, or record dates, you might miss some of these companies. It's my preference, and everyone has their own version of what that might look like. But it's very important for investors to know that there is a difference between the Aristocrat list and the All-Star list. That being said, let's first look at the companies which we think will not raise dividends this October. First up on our list of those unlikely to raise is Smart Centers Real Estate Investment Trust, SRU.UN on the TSX. So why don't we think the company will raise? Well, it raised dividends at this point last year. It has a 6-year dividend growth streak, over which time it has raised dividends in the low single digits, 2 to 3%. This year, however, is not an ordinary year. We all know this. And the retail industry has been significantly impacted by the pandemic and the economic shutdown. If you take a quick look at SRU's chart, you'll see here that the company's share price has absolutely cratered. It has gone from approximately $32 per share, and it is now trading in the low 20s. You'll see that the dividend has risen quite nicely over the past number of years. However, we're really not confident that the company will raise. Is a dividend cut in order? I don't think so. The CEO has come out several times saying that the dividend is safe. However, don't expect the company to extend its growth streak to 7 years in this current environment. We believe that there still exists considerable uncertainty, especially given that several provinces are now entering a second wave. So don't expect anything big out of SRU. The two other companies that we think may not raise dividends are Genworth MI Financial and First National. Even though we like these two companies, they may not raise dividends. We're actually not 100% sure. However, what we do know is this. The OFSI, which is the Office of Superintendent for Financial Institutions, has asked the banks not to raise dividends at this point in time. Ever since the pandemic began, they have asked banks to keep the dividend steady. Unlike in Europe and in US, where they set regulations that may have forced the banks to cut, the OFSI has essentially come to an understanding. It is a term, it is a way of guiding the companies. So they haven't flat out told them they can't, and they flat out haven't told them that they need to cut their dividends. But they are working with the financial institutions to ensure that they have enough liquidity to make it through this crisis. What we're unclear is if this mandate also applies to the other financial institutions, such as insurance companies. If you take a look at the role of the OFSI, you'll see here that all federally regulated entities, which includes banks and federally incorporated and registered loan companies, insurance companies, co-op credit associations, and fraternal benefit societies and private pension plans all fall within the mandate of the OSFI. Given this, it is likely that the OSFI has also guided and has also asked the other financial institutions, of which MIC and FN fall under, to also keep the dividend steady. Given this, we find it, once again, very unlikely that either of these two companies will raise the dividends. In fact, given our current situation, we don't see any financial institution raising dividends until at least 2021. Now let's talk about two companies that are likely to raise, but we're not ready to fully commit to saying with 100% certainty that a raise is on the way. And those two companies are Cogeco Communications and Cogeco Inc. So Cogeco is a parent company of Cogeco Communications. If you've been following these companies over the past couple of weeks, you'll know that Rogers has teamed up with US-based Altus in a hostile takeover bid of Cogeco. It's been quite interesting to follow. Rogers and Altus went public with their deal to buy the company without gaining support of the majority shareholder, which is the Odette family. They control 69% of Cogeco's voting rights. They have made it quite clear that they have no intention of selling their shares. So now there is a proxy battle happening. Both are sending letters to shareholders, trying to entice shareholders on either side of the spectrum. What might help Cogeco's case is if a dividend raise comes through for investors. Cogeco has a 15-year dividend goal streak, and Cogeco Communications has a 16-year dividend goal streak. Both companies have raised dividends by approximately 10% over the course of their streaks. So it's highly likely that they will want to keep these streaks going. Any sign of weakness may pressure the Odette family to sell their shares to Rogers and Altus. So at this point, we think that it's pretty likely that Cogeco will raise dividends, but we're not 100% certain. They are scheduled to release quarterly results at the end of October, so stay tuned. It's going to be a very interesting earnings call. Finally, we turn our attention to the two companies that we think are most likely to raise dividends this month. The first being TFI International. Our premium subscribers will know that we are big fans of TFI, and it is one of the best capital allocators in the country. In fact, as the pandemic has impacted a lot of the transportation industry, TFI has been opportunistic and has picked up a couple of companies which it is going to bolt on to current operations. We think that it is well positioned to once again raise dividends. Take a look at its beautiful chart here. Since the company began raising dividends about 9 years ago, it has raised dividends by 150%. Take a look at its chart as well. It has returned 434% over that period. Given its strong performance and the fact that it is performing quite well over the course of this pandemic, we believe that TFI International is well positioned to once again raise dividends. Over the course of its 9-year streak, it has raised dividends by double digits. No reason to expect any different this time around. We think that along with their quarterly results coming up at the end of October, TFI will extend their dividend growth streak to 10 years, and once again, we're looking at about a 10% raise to the dividend. The other company in this category is Waste Connections. Waste Connections has a 10-year dividend growth streak, over which period it has raised dividends by approximately 15% annually. Last year's raise, 15%. This year, we expect much of the same from the company. Since, like clockwork, the company has always raised dividends along with third quarter results at the end of October. Given that it is one of the most defensive stocks to own, and it is well positioned to do well regardless of economic condition, we don't think that the pandemic or an economic shutdown is going to impact the company in a material way. Therefore, we expect a dividend raise is all but a guarantee at the end of October. So with that, let's recap what to expect this month. We have 3 companies, Smart Centers REIT, Genworth MI Canada, and First National, who we think are going to keep the dividend steady. We don't think a dividend cut is on the way. However, it is unlikely that a dividend raise is coming, despite having a history of raising in mid to end October. Next, we have Cogeco and Cogeco Communications. Both companies have very impressive dividend growth streaks. However, they are now in a proxy battle. Which way it goes, we're not entirely sure, but we believe that the company's strong history is a sign that a dividend raise is on its way. Finally, we have 2 companies which are all but guaranteed to raise a dividend. That is Waste Connections and TFI International. Both are doing well during the pandemic, and both are well positioned to raise the dividends. The only reason why a company like TFI International might not raise a dividend is because it has been deploying capital towards acquisitions. However, we think it has the capital to both raise the dividends and execute on its growth through acquisition strategy. Before I close, I also wanted to point out that the Aristocrat list does not include funds. This is why you'll see stocks like Brookfield missing from the Aristocrat list, even though they have a strong history of dividend growth. It's yet another quirk that separates itself from the All-Star list. In my opinion, if you're going to pick between the two, the All-Star list is the better list. I'm not a fan of the fact that a company can keep their dividend steady for 2 years. There are too many companies that have remained on the Aristocrat list and have overstayed their welcome. Case in point, Chorus Entertainment was on the list for a while, and despite clear signs that the company's dividend was going to be cut, it remained on the list despite a very high and elevated yield. Highliner Foods is another one that fell under that trap. So I'm not a big fan of the Aristocrat list. If you're going to pick one or the other, I'd pick the All-Star list. As mentioned, my preference is to track the companies which have raised the dividend and which have paid out a higher dividend year over year. So my philosophy aligns more with David Fish's CCC list south of the border. With that, what are your favorite dividend growth stocks? And tell us, do you think that Smart Centers or perhaps Cogeco will raise the dividends? Or do you think Waste Connections and TFI International might not? Let us know in the comments below. And as usual, please like our video and subscribe to our channel for more great Canadian content. Until next time.